All right, good afternoon. We're going to do a quick webinar here discussing why everyone should use a whole life policy if they do not get their taxes stolen from them monthly. As we all know, some people have to pay their taxes up front. Most entrepreneurs, most property owners have to pay it once a year, quarterly. I brought my friends from Atlas Wealth on here to show you a new system on how you should be paying your taxes so that you can capture the most value out of the velocity of your dollars.
Awesome. Hey, Jimmy, thanks for doing that, man. We're excited. So my name's Ryan, and Jimmy and I, we've known each other now for about 6 months, and I'll tell you what, we've had an awesome 6 months discussing philosophy, strategy, how to make, whatever we're doing better and how to do it with a better overall system. And so what we're going to do today is we're going to introduce you to a way, as Jimmy said, to pay your taxes more efficiently. As fun as paying your taxes is, if you can add more efficiency and come out of that game further ahead, then that's really what we're going to show you how to do, is how to keep more of the money that you make as opposed to just blindly going with the crowd and doing it the way everyone else does it. So in order...
Thanks for introducing me, guys. I'll introduce myself for a second. And I'm Brad. And same with Ryan, man. Knowing these guys at Joint Ops, it feels like we've known each other for years. Like we think the same, we see the world the same way, right? Jimmy, this has been a lot of fun getting to know you guys. But so this is really for anybody that, like Jimmy said, entrepreneurs, business owners, real estate investors, anybody that has control over how they pay their taxes, or like Jimmy more effectively put, anybody who controls when they're stolen from. This is going to be groundbreaking for you guys. So pay attention.
Awesome.
Originally, Ryan, when we first started talking, I thought this was a cool way to make my balance sheet look better and to avoid my savings being taxed. But as we kept going down the rabbit hole, we are discovering new strategies every day.
Yeah, and one of the things I love about that is, once you understand some of the core principles around how this strategy works, which we'll go into some of those today, the possibilities of how you can use it are literally infinite. Today we're going to show you a very niche, unique strategy to pay your taxes more efficiently, if there's even such a thing there. But no matter who you are and what stage of life you're in and how you're handling your finances, this strategy will add an element of efficiency to your financial strategy. Is really what it comes down to. So we're going to go in, we're going to do just a quick analogy before we dive right into the numbers. And this analogy, I think Robert Kiyosaki is the first guy to introduce it. At least that's where I remember reading it. But he gives an analogy of McDonald's, right? And what we're talking about then, Robert Kiyosaki, he had a strategy, or he had an analogy of McDonald's. And the McDonald's analogy was simply, if you're going to go and have a competition with McDonald's, and if you want to go out to your backyard and McDonald's brings their chef to your backyard, which one out of the two of you, between you and McDonald's, can cook a better hamburger? Now, Brad, I think you've had everyone that you've given this analogy to say they could cook a better hamburger, with the exception of one person, right? Wasn't it your vegan mother-in-law?
My mother-in-law, who has been vegan for 30 years, she says she's not sure whether she can cook a better hamburger or not, but that's it.
So there's one person out there that McDonald's can beat, but most people out there are going to come to the table and say, for sure, I can cook a better burger than McDonald's. So the question is, if we all can make a better product, than McDonald's, what is it about McDonald's that makes them so successful? And we all know McDonald's, they're not in the business of Big Macs. They're not in the business of burgers. They have a better system. And if you think about it, if you've ever been to a McDonald's, and I know, most people don't want to admit they have, but if you've ever been to a McDonald's, you can go to a McDonald's in California or a McDonald's on the other side of the world, and no matter where you're at, you'll get the same product that tastes the exact same, that's packaged the same way, that costs probably the same, and you're going to have that delivered by probably a teenager. So the least common denominator, anyone can run their system, and they've had a system that enables them to scale and leverage their model globally. So that's really what we're talking about today, is we're talking about having a better system, and whether you're getting stolen from by the government when you're paying your taxes, or you're acquiring rental real estate, or you're just managing your household budget, this system applies to whatever you're doing to make it better.
You're doing the same amount of work and you're going to make more money.
You got it.
You're going to keep more of your own money. Bought these policies, we were at about 80 properties. So right now we're at about 100. But I was thinking, we've been escrowing our taxes every month. Or let me go back for a second. So our tax liability and just property taxes, not income taxes, for joint ops properties is going to be 80 grand. So every month I take money out of our checking and I used to put it into our tax escrow savings, where I'm making no interest. The little interest I'm making is taxed, all things I didn't like. So I needed to find a way for that liquid capital to continue to benefit me. After I bought my initial policy to start buying real estate with, I started thinking, wait a minute, I could put this escrow into a policy, and when I give it to the government at the end of the year, I'm still giving about a 5% dividend on that $80,000, even though I don't have any of the money anymore. Like, to me, that's logical. I'm making interest off money I don't have anymore.
Yeah, it actually flips the table on the government, because most people that pay their taxes as they go, it either sits in well, it's one of two things. It either sits in a checking account, and Jimmy, when you were putting that money in the escrow account, what was the bank doing with it? Did they like put it in an envelope and write your name on it and hold it, waiting for you to come back?
Yeah, they loaned it out 10 times that amount.
So they're making huge amounts of profit on it. So either banks are profiting off your money, or if you're like a normal employee sending your check to the government every single month, the government gets it 12, 11, 10, 9, 8 months before you actually have to give it to them. So they get to go spend it and do great stuff.
If they overcharge you, they don't pay you interest. That's the worst part.
And the stuff that you do have to pay, if it's not due till April 15th and you give it to them in January, the government gets it for 14 months before you needed to give it to them, right?
I would love to take money from people for 14 months and pull interest off it and then give it back.
Yeah.
That would be incredible.
It's a pretty good business model. Match what the government has.
Those dollars they're taking, there's zero cost to them for those.
Yep. And they get 14 extra months out of it. So what we're going to do is we're going to flip the tables and say, what if we could build it into a system that we get to control, we get to benefit from? It's going to be a pretty cool outcome, because, Jimmy, you actually, in your mind, calculated how many properties you get to buy using Uncle Sam's money. We want to run this out kind of, let's say, 15 years of paying. The first, don't fall asleep on this, is what make this really easy to understand. Jimmy's growth, this is kind of where we're going to be. We thought in 2 years he'll probably double his taxes, and let's say it grows at 10% per year from there. It'll probably be faster than that, but we wanted to stay sort of just in a nice linear. So that's...
We're purchasing properties at about that clip, and when we buy, it's about $1,000 a month or a year per property for taxes. So that's an accurate number.
So we're just going to move through. So 15 years from now, he's going to be owing $500,000 a year in property taxes, which is kind of a cool thing, but also disheartening. This is what you would end up paying to the government, Jimmy, over 15 years in taxes, $4.5 million. If you didn't
St. Louis, a bunch of that money goes to the St. Louis Zoo. And you would think that at a minimum I could get like a bench, like the joint properties bench that I could show to my children with pride. But I don't even get a bench.
No, and you get thrown under the bus anytime anything happens economically, because you're the evil capitalist, right?
Yeah.
So if you pay cash, that's that first column. It's just 80,000 in, 80,000 out, 160 in, 160 out, 176, 176 out.
Every December 31st, I can't tell you how painful it is for me to write that check. It's miserable.
It's a big check, right? Now, everything to the right of it is a better system, okay? Rather than taking the check and writing it to the government, Jimmy, we're kind of talking about this of adding extra money to the policy that you have, okay? We're not going to get into all the details of how we structure insurance policies, but if you did that, you could write a check instead of the government. You could put it in your policy, and they'd give you back $76,000. Okay. So the first year you got to come up with a little bit of money, about $3,200. So your total cash out of pocket is going to be this far right column. Did that make sense?
Yeah, we can handle the $3,000.
Okay. Hopefully you could, right? Put it on your credit card if you need to. So that first year is the one where we got to come up with a little bit of money, but then this deficit column here, you can see we're getting as close as we can, but you pretty much have enough in the policy every year forward to be able to take from the policy and pay the taxes. And the mechanism here, what we're doing is, this is what's going into premium into the insurance policy. You can see it's significantly less than what we're paying in taxes, because we just want to get enough in there to then be going in and out of the policy instead of in and out of your checking account, right?
Yeah.
So we need to build up and keep enough momentum through the policy. And the idea is the earnings on the policy are going to be in to pay your taxes for you. Okay? So each year you take a policy loan, you repay the loan, you got to add a little bit to the policy to make sure there's enough there. And if we do that, this is the number that we want to look at. At the end of 15 years, you still paid a lot in taxes, but because we used this system, you only came out of pocket $4,315,000. instead of $4,555,000. No different risk, no different. You do the same exact thing you were doing, but net after all income taxes, you've got an extra $240,000 in your pocket. Okay.
Now, I can't really say that's 20 grand a year because it builds in the later years, right?
Yeah, it's going to be. I mean, we all know what a compound interest curve looks like, right? Yeah. So we're going to see more of that benefit toward the tail end. The first year we're actually in the hole on it, and we see that benefit as we go. But Jimmy, your income tax rate is going to be somewhere near, everyone's income tax rate is going to be somewhere near 50%. So if you were to try to go earn that money through your operations, you're going to have to earn somewhere close to $500,000 to net 250, right?
Right.
So Jimmy, how many properties do you have to buy and be operating to net 250 grand?
Well, so our average cash flow per house is around $300. So 240 divided by 300 divided by 12, that's another 60 properties.
That's like having another 60 properties.
That's close to, yeah, I mean, that's close to half my portfolio right now.
Okay, it would take that much more. Now, the properties are paid every single year, so that's, I mean, but it's a way to think about, look at how much additional profit we can have if we don't turn our money over to banks or the government. And instead, we run it. That's money that now, like we said, we turn the tables and we got that back by having a system that we're in control of. And even I know people that won't save money in a bank. There's really good reasons to not do that, but their next best choice is they keep this $80,000, $160,000, $176,000. Literally, I've seen people with a safe in the corner with cash in it. And then they take that cash and they make their payments. But that still doesn't, that cash doesn't magically grow or replicate or duplicate in that safe, right? But here we get the same security and privacy of a safe, but it gets to work for us as we go.
Can you show this illustration in a policy and show the dividends?
Ooh, boy, Jimmy, you threw me on a loop here. Let me see.
Because to me, the magic is the dividends that with money I don't have anymore.
I don't have it calculated because I interpolate it with our software, but basically the idea is that $240,000 is the dividend that you're receiving. You're using that to pay your taxes instead of money from your own pocket. So the total dividend over this 15-year time period is 240 grand. I don't have a year-by-year breakout. I just didn't pull that out.
Can we have the illustration for our policy, Ryan?
Yeah, I can do that.
And maybe if you guys could go through the stair-stepping, just the analogy of the stair-stepping.
Yeah, Ryan, why don't you do that? The illustration you're going to bring up, we had to do, because remember, we showed this as you adding extra to the policy that you already had, so it's not going to, we had to do a couple layers of math to break this out.
Yeah, so really what it comes down to, and Brad, help me out with the drawings here on this, but think about it from the standpoint of if you use cash or if you use credit, you really end up in the same location, right? And I mean, if we take the escrow discussion off the table, you know, Jimmy, if I came to your office right now and I said, hey, Jimmy, I've got $100, I don't want it, you can have it. For most people, there's really only two options of what you could do with that $100. You could save it or you could spend it, but you can't do both. So with your taxes, it's kind of the same way, right? Every single month, you kind of set money aside with the anticipation of paying the government when the time comes. So you kind of go up this little stair-stepper approach. When you have the 80 grand at the end of the year and you're ready to make your tax payment, you draw it down to zero, you pull the money out, you make the payment, and then you start the same process all over again. And that's really how most people handle the majority of their finances. If you're not using cash, you're using debt. And all debt is, it's the same thing. We spend the money now, and then we spend the next amount of time paying off the debt. But in both cases, we end back at the same spot, which is break even right at zero. And whether it's escrow taxes, whether it's taking your family on a vacation, whether it's buying a car, putting your kids through college, I mean, think through your budget, think through your life. How many things are reoccurring expenses that come up over and over and over again?
Let's take next year when I get to June. I'm going to have at least 50K in this escrow, right?
Yeah.
That's a house for us right there.
You got it.
And that's money. I could get a tenant, I could buy it in June, I could have a tenant in July, and I can have it refinanced and have the cash back ready to pay my taxes by December.
Yeah, you got it.
And that's the amazing thing that we didn't even include in this discussion. We just assumed you continued paying cash and you weren't even smart enough to find something amazing like you just said, what you could do with it, right? So where Ryan kind of talked at the beginning, there's almost an infinite number of ways that we can leverage this and do something with it, just because we just need to make sure the money's in the account at the end of the year. Just like you said, you could buy a property, refinance it, put the money back, fill up the difference with the cash flow, and still have the money ready for the government. So not only could you have the $240,000 of extra dividend over that 15-year time period, you could own additional properties on top of that.
And by the way, I'm getting 5% compounding tax-free from the insurance company every year.
Yeah.
I mean, to me, that is magical.
And that's really all it is. I mean, Brad, go back up to that compound graph. I mean, all we're going to do is we're going to run the same system, but now we're going to do it via compounding, because with one of these policies, you have a really unique opportunity to where when you take capital and use it as a policy loan, you're in control of the policy loan. So the insurance company will never ask you why you're taking a loan, when you're paying it back, or how you're paying it back. So we need to be a good steward and have a strategy over it. But when you take capital out, we don't break compound interest. The loan literally comes from the life insurance company, and they use your policy as collateral. So every single year, Jimmy, as you're paying your taxes, your money is continuing to compound, and as you're paying the policy loan back, it's just like saving for the next year taxes. So that's why it's a system.
And that number you're throwing right there, that, this is speaking conceptually, but that number, those dollars right there are dividends for dollars that I don't have.
Yeah.
For assets I don't have.
Yeah, you've already deployed.
The exact same way a bank does it. They make money on money that's not theirs. You're making money on money that you don't have anymore. You've paid.
Well, really, it's mine, but it's been stolen from me. But
not in, typically, unless you use this system, it's not in your control.
Yeah, and to me, that was mind-boggling, because I could be doing this with my insurance premiums for property insurance. I could be doing this for my sewer and water.
You got it.
It's just a matter of becoming liquid enough.
You got it. And that's honestly, that's the whole thing. I mean, I know we just went right at it with escrow, but man, over the years, Brad, how many different things have you and I used our policies for? From starting businesses, my son had a crazy emergency surgery that we had to do a couple years back, to going on vacation, to buying a ton of rental real estate. I mean, if your money can literally do two things for you at the same time, if it can compound and grow and give you the ability to access the value of that capital in the short term, you can accomplish short-term objectives like paying your taxes and long-term objectives like having your money compounding and growing over a long term. And Brad, at the end of this 15-year example here that you've got, let's say, Jimmy, you sell off all of your properties, right? I mean, now you've got this cash value balance there that you can start using for other things should you choose to do that. Here's the two with you guys together. So what we've got here is we've got you and Bob putting in $36K each year into your policy, right? So a combined premium of $72,000. And then if we come right over here to the combined cash value, in the first year we have $59,000. This is the money that we're talking about using outside of the policy for taxes, for more real estate, for whatever business expenses we have. It's easy to see in the first year that we've got to come out of pocket. There's a cost to this system. Now we recoup that cost many times over, but first year you put in 72, you've got 59 coming back. Second year you put in 72, your cash value goes from 58 to 125. So it goes up by $66,000 in that year. We've almost overcome the cost, quote unquote, of insurance. By the third year, we've done it to where you put in $72,000 and your cash value goes from 125 to 203. It goes up by $78,000. So at that point, that's when we structure policies in this way. Most people, when they think of life insurance, they think of it literally as life insurance, and they buy a death benefit, and the only benefit they get is if they die. This concept, we just structure it completely opposite. We buy a policy that's structured around what you're trying to accomplish. We build as much cash value into the policy as early as we can and still have it qualify as life insurance. And by the way, Jimmy, if you pass away in year 3, right, Bob, or however we designate this, he has a tax-free death benefit coming back, so there's that added icing of life insurance that's still on there. But now we have
and where you can't get this in any other investment, this suffices as me and Bob's buy-sell.
Yeah.
So exactly. My wife doesn't know how to manage real estate, doesn't know how to do this, and I don't want her to have to do this. So if I were to die, that 1.4 million goes to pay off the debt on the houses.
You got it. You got it. So
And
there's
so me and my wife sleep better now.
there's
So
Yeah, actually,
let's also show how between 58 and 72, I'm down 14 grand. And then in the second year, I am down.
you're down about what? So from 72 to 66, you're down about $6,000.
Okay, and then when I'm even, essentially that 18 grand I was down has been overpaid by dividends from the policies, correct?
Yeah. So we want to
So
jumpstart it.
I essentially have made 18 grand off money I don't possess.
Yeah, you got it. And that's kind of the big picture of this whole concept is, man, over the next 10, 15 years, let's use this capital, this cash value for whatever we need to do, whatever our short-term objectives are. You know, Jimmy, you've already on your personal
This is why
side.
I'm saying that anybody who doesn't pay their taxes monthly has to have one of these policies. Throw it into the system, be getting a dividend off money you don't even have, money you know you're going to spend.
Well said. So yeah, I think that's kind of it, man. Jimmy, you want to close it off for us and kind of tell your guys what any final thoughts that you have and what you want them to do from this point on?
I mean, I'm going to throw this on YouTube and Facebook with, if you don't pay taxes monthly, you need to watch this video. And I hope we did an adequate job explaining to people that you can make money off money you've never even had. And before I learned about whole life insurance, I was in a situation where I had to earn money and I kept 65% of it, and that's what I could invest. So I could only invest 65% of the money I made after taxes. And now you're right, Brad, the tables have been turned.
yep. Good stuff.
Okay, well, Jimmy, hey man, thanks for inviting us on. That was a fun discussion, man. And this can go in any different angle. I mean, we can take this as deep and as wide as you want to take it.